If we look at these liquidity models and you look at them all the way back to the global financial crisis, they've really worked pretty well until the last 18 months. And what we're talking about here, particularly if we focus on the right-hand model, is we're talking about marginal liquidity in and out of the marketplace. And really, there's two main assets out there that matter. There's the equity market and the bond market. They're the big babies, the big assets, the big market caps, and everything else is in a sense a bit of a sideshow in financial markets. Obviously, housing is very significant, but that's not a financial market story. That's a different ballgame. So when you think about market liquidity, it gets absorbed by equities and bonds primarily. And that's why I think the chart on the right-hand side really works pretty well over the last 15 years, because there's a lot of sources of liquidity. And for example, the main ones that have been around forever would be people are saving money every month into their pension. Some of that's going to financial markets, or most of it goes into financial markets. You get big asset allocation switches when asset allocators go from being bearish about the economic cycle to being bullish. They'll shift money from bonds into equities, and that has a big liquidity impact. But all of those are going on all the time. And in the last 15 years, in terms of net new marginal liquidity, what's been really important is this net Fed QE less net Treasury issuance. In other words, how much new liquidity, newly created money, is the Fed putting into the system versus how much extra bond issuance is the US Treasury doing, and therefore sucking out liquidity from the system, leaving less for equities. So net QE or QT, less net government bond issuance, gives you the black line you see on the right-hand side, which correlates pretty well with the S&P 500 until the last 18 months.